Hey, what's going on YouTube? Kenny here, and today I'm going to tell you what I think happened to the markets today. So a vicious drawdown today. The S&P down, the NASDAQ down, the Dow down. NASDAQ down almost 6% low of day, stabilizing a little bit here at negative 4.99% going into the close. So that said, I'm going to break down what the pundits have to say. I'm going to tell you what I agree with, what I disagree with, and kind of try to bring some clarity for y'all. This is really just for my subscribers because, you know, when these things happen, I generally try to come up here and try to be an adult for you all, but really all I'm doing is trying to break down kind of the theses that are existent and tell you whether or not I agree or disagree with them, and then really try to think about a strategy that will kind of serve us in the long term and in the short term as well. And I'll tell you most of that has to do with psychology, but really fundamentally trying to break down what the hell is going on and bring some clarity for you all. So we'll go ahead and get into it, but seriously, we're just going to take it easy today, kind of take it slow and kind of think through this in processes. So here is definitely the roadmap that we need to be looking at. As you can see here, again, very small pockets of green, but not really. I have the Tesla here, consumer defensive, negative 8.41%, really no place to hide. It's very hard to hide your money right now, especially in the equities market. So, I mean, that is indeed why, you know, all these sentiment indicators and this positioning indicators for some of the funds and the fund managers are showing a very large amount of cash and a very steady drip to the downside, a little bit of a sell back in to the day. But again, if you watched yesterday's video, we did talk about how, you know, right now in a bear market with the trend, dominant downtrend to the downside, you should be selling most of these rips. And yeah, we did take a little bit of a hedging position yesterday just in case on ARKK, just in case we got a little bit of a rally. But I mean, it was a small nominal position. We did get blasted out of that, but of course we sold it on open. And you know, we are definitely in an interesting spot right now. But I mean, we have been thinking that this would be very bearish, and we're going to go ahead and talk about why I think so and why maybe the conclusion is not here yet, or capitulation, if you will. So if you kind of listen to some of the folks and what they're saying, one of the things they're going to talk about is obviously inflation and inflation, right? So this is a chart, and this is UK monies, but still very relevant. The idea here is we just don't know what actually causes inflation, and we don't know what levers or mechanisms we use to kind of get that under control. What is my point? My point is, you know, we're thinking about like, hey, the stock market goes down, that fixes inflation, and that's what Jay Powell is trying to do, the Fed. And this chart is showing that, you know, printing money, which is probably one of the biggest tools that people think of when they think of kind of supply and demand, like money contraction should lead to less inflation. But real interest rates here, which is the thing that the Fed can control and is trying to control, basis points, et cetera, et cetera, et cetera. You've heard the noise. But here's inflation and money supply. There's no correlation. So it just doesn't really matter, at least in this kind of spectrum of this kind of channel, at least, to what happens when it comes to real interest rates and inflation or money supply. So it's just a thought, and just thinking through kind of, you know, quantitatively why this happens. This shows almost no correlation. So the other thing that I looked at that I found was very interesting, and if you're wondering why, like yesterday we whipsawed to the top side, and of course that's obviously I don't want to overuse the term because I feel like it's a little bit ubiquitous now, but like it's a little bit of a squeeze, right? People are a little bit off sides, and you know, a little bit of pressure is going to cause a lot of fluctuation. So huge fluctuations to the top side, and you know, prints what I like to call the London Bridge, which is essentially momentum back down today, and no competing momentum or no competing bid to kind of keep that from falling. And as soon as we fell through about this piece of the pendant or this kind of triangle, we definitely sold and got out of any long positions that we were holding in our trading accounts. But we'll break that down in a second. But this is the SQQQ, so triple leverage short the NASDAQ. I'm showing you this because traditionally we sit in on volume of 4 million. And just look at the amount of growth And so, when the market started to tumble here, and in September of last year, the writing was on the wall, right? In February of last year, it was started to draw down, but in September, the writing was on the wall for most folks. Still slow to move. 15 million average volume per day here going through here. But here, look at this. 10 times that, really. 10 times plus, right? 120 million at this top end right here. It's obviously increasing at a linear scale here, but still 120 million in average volume, and this is short interest. So it's not just, people are kind of like bearish. Reference the AAII. If you don't know what that is, it's a contrarian indicator showing retail investor interest, or whether or not they're bullish, neutral, or bearish. This print came out very bearish, but this is saying that not only are folks bearish, they're taking action on it, right? So obviously with volume like this, and if you're wondering, if there's this much volume, there's going to be these huge, massive whipsaws. So whipsaw to the top side, obviously totally possible. Whipsaw to the downside, as you can see today, which is the most logical piece because, of course, again, dominant downtrend on the S&P 500, like we showed you yesterday, to the downside. So we're going to take a look at the VIX really quickly because this is very relevant. So last year, the kind of construction of the VIX, or the kind of structure of the VIX, said that we can always buy on 25 and it's going to draw down. Statistically speaking, over the years, 36 is actually the, hey, you got to buy here, you got to try, or else the stock market is broken. Well, guess what? With all the headwinds that are here, especially given today, and given the months following into this with the war and with everything else going on and the Fed headwinds, 36 has been the number this year. And so the VIX structure this year has been 36. So if you bought around 36 each time, you've definitely done well for yourself in terms of just buying the dip. And these are trades, obviously. And this is if you're looking to DCA or invest, 36 you got to buy. You got to buy a tranche, you got to try. But my point is, right now, we are not at 36 yet. We're at 32.98. And traditionally, you want to wait until about 14 or 15. But this year, I don't even. It's been it's been hard to even get to 20. So right now, my thought for myself, at least, obviously, is to sell around 25 land. So once it hits about 25 here, should have sold. I didn't. And so I'm still holding a short on UVIXI right now, but we have plenty of time for that. I know the decay is working against me. I get it, boys and girls, but I'm just saying that's where we sit, and that's kind of my hedge against the market kind of taking off. That said, we are working our way to 36. If we pop through 36 and see some serious capitulation, like 40 plus is some serious capitulation, then we can start to think about whether or not this market has bottomed. Today was one of the very first days, though, that actually showed that. And you can see that in how big this wicking candle is. So if this is an igniting candle, look at how large that is relative to even anything back for the last 5 months. There's no kind of greater wick except for this one right here, but that didn't stick. So definitely stuck the landing here and no rejection yet. So still working our way up to 36. We still have time here on the daily chart. Still not overbought. So one of the things that folks are talking about, and I do think that this is a good way to look at it, it's definitely one of the headwinds. Worker output fell by 7.5%. This is the biggest decline since 1947. Very, very substantive. The thing about it is not that it just fell by 7.5%, but at the same time, labor cost as measured against productivity soared. So 11.6%, it costs more to do the things that it needs to do. So labor cost 11.6% more, and it was about 7.5% less productive. So that's pretty substantial because you have both ends of the tail here, and you're kind of opening up that spread. So in true terms, that number here is a lot more bigger, if you will. Pardon my English. So you're asking, Kenny, what are you guys doing about it, and how bad did you do today? We were actually up on the the challenge account. So this is the $100 challenge account. I'm showing you this because there's kind of two ways that we play this. We have our trading accounts, and then we have our long-term investment accounts. And so when we started this channel last year, one of the things we did this year was we opened up an M1 Finance account, which holds our what we call no-look portfolio. We do quarterly rebalancings if we have to, or in dire emergencies, but we tend to not look at this portfolio at all. So we don't look at this portfolio. That said, this is our trading portfolio, and this trading portfolio, as it grows, it can flow money into here, or it can just grow on its own. This is our trading portfolio, and we started with $100. And you're like, Kenny, why did you start with so little? I'm really just trying to show off the fact that it's totally possible if you know what you're doing, and you can kind of, navigate through some of this noise. You can do probably okay. Could this? And so make no mistake, I absolutely know that this thing can get blasted, and we could totally go down to zero, especially in the way we trade. But I'm just saying that, if you take the correct amount of risk to reward, and you're patient enough, and you take some positions that are right, and you cut your risks, you cut your losses as fast as you can, when you can, if it doesn't go according to plan, that you can do very well. But the long-term investment portfolio, again, is the kind of bread and butter. And we started that with 500 too. And essentially, this is a 5 to 10 year kind of plan here to show that, no matter what, even if the trading portfolios, or the itchy portfolios, I like to call them too, don't survive or don't thrive or aren't able to bring money back into the long-term portfolio, this long-term portfolio on its own, given the next 5 to 10 years, will still hit $1 million. And so that's kind of like my thoughts on that. Obviously we're adding money every month, and I always encourage people to do that, but obviously it's just showing you what typical normal savings can do with a normal job. And so again, we were long Cosmos. We got some signal for Cosmos. It didn't really hold. We had signal for Oxy too, so split the difference. If we would have had more money in this account, we probably would have taken both, and the Oxy call would have printed. Cosmos didn't hold up. It was okay, and it started falling at the end of the day, and I didn't really feel like holding that much risk because, again, very, very sensitive to how small this account is. But all in all, it started with $100. We're at $278.87. The high of this account has been almost about $400. So this is a little bit of a drawdown, but I'm not too worried about it. We'll start thinning out some of our positions, and we can probably try to take smaller positions as well. So I'm just saying that right now, risk to reward, one of the things we're doing in our trading accounts is being very, very sensitive to fluctuations. If you're winning, take the wins. If you're losing, get out. It's not one of those situations where we have these huge, massive, long-term kind of thoughts. We do have some account maker trades on, but that's in our kind of longer portfolios or longer trading accounts, which we don't have one against in our public portfolios. So this is the Red Cliff Fund. Again, we're getting blasted this year. We're down $615 off of a $3,200 kind of input, right? So we're down 27.93%, so 28%, call it. It's actually not that bad. Just so you know, like, I'm beating Kathy. I know that's not really hard to do, but RK is down 55%, I think, this year. And so if you're likening this to some of that stuff, we're actually not doing too bad. I know this looks like we're getting blasted, but we're not really doing that bad. We do have energy stocks in here, of course, so that's been saving us. We did have Zynga, which had that massive 58% move to the upside, and we sold out of that. And so we're doing decent. It's not great. I did make a bunch of mistakes, but that's okay. But in general, in mass, as long as you don't like overreact to things, and this is the account that's slow and methodical and has time to not overreact, you should do fine if you know what you're doing. And so this is kind of our way of showcasing that. So here's a wrap up. And this is what I really, really think. Bottom line is that people with money, or the people holding the money, and it's probably not you if you're watching this YouTube video, those people don't think it's a good idea to invest right now. They don't think it's a good deal. They think things are too expensive. They think there's multiple contraction that's going to happen. And they just don't think, given all the stuff that's out there, reference the Ukraine, reference the economy, reference inflation, reference the Fed, that they should be deploying money yet. And until those folks get to a point of capitulation, and that's a word that people use over and over again, but what that means is in your heart when you feel it, and it sounds stupid, but this is really the psychology of money. The psychology has to be behind this. What has to happen is there needs to be a turnaround where people look at the numbers and they look at the prices and they say, oh my God, if I don't buy now, I'm never buying. Like, this is way too good of a deal. Either that or the stock market is entirely uninvestable. And obviously that's not a thing. Obviously this millennial cohort has to buy into the stock market. So, good for them because they will have a bunch of deals here. They won't be buying at market highs. That's kind of a good thing. And so, here's the thing. If you think about it, they may be smarter than you. They may not be. But that's essentially what they're doing. They have to do what I'm calling protect their money. And so, there's two kind of things that we always talk about here. There's money accumulation and then there's money protection, right? So, money preservation looks a lot different than money accumulation. And so, the people who are losing the money right now are the ones who are probably trying to accumulate at a faster rate, unless you obviously know what you're doing and you have mostly puts and you've been fading all these rallies. And so because of that, right now the smart money is generally kind of sidelined and looking to deploy when they see very, very good deals. And those deals don't stay there for very long. So just be ready to kind of get your money in there once this recovery happens if you are on the sidelines or cash rich. Okay, so the other thing I want to talk about is institutional memory. If you don't know what I'm talking about, is essentially the fact that recency is really important. And so we talk about sentiment half-life here a lot. But institutional memory is essentially the same thing. Now, I don't have any academia to really express this to you in numbers, but here's what I'll tell you. In the same way that in warfare, there's certain tactics and techniques that guerrillas tend to use over and over again because, even 40, 50, 60, 70 years ago, their fathers taught them in their basement or in the woods. It's the same way in the trading market. And this is what I mean. Follow me here. Essentially, the crash in 2019, 20-ish, the COVID crash, people deployed money too soon. People were a little bit too anxious to get the money in there and buy a deal because there's been such a kind of dominant bull trend. Everything looked like a good deal, and nobody knew kind of the ramifications or where COVID was going to take us. And so what I'm saying is, we've learned a lot of lessons from that, not just me and you, but there's people who've modeled that, right? And people who've modeled cyclicality, so cycles. There's a lot of cycle work being done right now, and a lot of people think that July, August, we might turn the corner. And if you're wondering why that is, that's indeed cycle work. And so, when I say hey, end of July is probably where we turn, regardless of what happens, that's generally cycle work. And this looks like it fits that kind of paradigm. So nobody thinks that the bottom is here yet. And if you do, okay, you probably can't get hurt buying here. But, if you have a lot of money to deploy, it's probably okay to nibble. But, do your thing and get ready to swallow your pride if it goes down a little bit more. And then finally, when in doubt, don't fight the Fed. I mean, we've been saying that over and over again. That's rule number 1. It's also rule number 2 and rule number 3. You just don't fight the Fed. Whatever the way the Fed is taking you, go ahead and play that side of the trade. I mean, there's just really no reason to go against the JPOW. So right now, what we're doing is obviously on our trades, we're very fast, we're very nimble, very agile, if you will. And on our long-term portfolio, we're still making adjustments. We are looking to buy some serious deals right now. I do like Netflix where it's at. I like Snow probably a little bit, not right now. There's a bunch of other names, obviously. I know you all are shopping as well, but I'm looking at management teams mostly, and I'm looking at just scaling. The other thing I'm looking at is some of these big consumer discretionary names, and I've talked about it in the chat right now, but I'm still thinking through my thesis. But essentially, there's still multiple contraction to go with some of these defensive names, and I think the defensive names will topple once the money inflows come in. And I think what will happen is when these tech giants start to have this multiple compression to such a finite space, meaning so small that there's no other way about it, and you're man, I don't want to give it away, but seriously, like you have these defensive names with like these really slim margins with huge multiples. And so, right now I'm looking at those names and getting ready to short those as well on this flip. So we're going to wait for this flip, but we're going to get ready to do that for sure. Anyways, those are my thoughts for today. What did you think? It's just me working through my process and, genuinely taking my time and thinking through this. This was one of the longest videos we've done in a long time, so I don't think it performs well, but it's good for my subscribers. So anyways, apologize for everybody for the long video, but really, I don't think I wanted to do this any faster. So, hey, if you like this kind of thing, you know what to do. Take care, and we'll see you tomorrow.